right, so I want to walk through activity 4 with you guys really quickly. The activity for chapter 4. I'm going to go through part of it pretty quickly because we did it in class on Monday. If you weren't in class on Monday, sorry about that, but you'll need to watch the lecture videos and kind of get caught up on where we're at. So I'm going to go ahead and fill in the blanks here and just make it a little easier for us. That way we can go ahead and get to the journal entries, which is kind of the meat of this chapter. So this first one here is accrual accounting, right? Accrual accounting is what we're doing in this class. It is the whole premise and basis of this class. So the double entry accounting system that we talk about, for every debit, there's a credit, all that good stuff. That is what accrual basis accounting is. And again, we know the reason we do it, or you should know the reason we're doing it by this point, and it's so that we provide a better, more accurate, more representative story of our financial health for the company. Okay, so under accrual basis accounting, we record our assets when they are obtained. Okay, so when we get an asset, we record it. We record our abilities or our liabilities when they occur. Okay, so when we have somebody that we owe money to, now we have a liability and we record it then. Revenues are recorded when we provide the good or the service, right? We earn the revenue, so we have to provide it first. And then expenses are recorded when the costs are used. Again, this word used is something that I try to really force into you guys' minds when we're talking about things like expenses, because when you see a word like used, when you see a word like incurred or expired, those should indicate to you pretty strongly that there is an expense involved. At least one of your accounts will be an expense. This next part, cash accounting. So cash accounting records transactions when cash is received or paid. Okay, and that's it. That's the only time we record a revenue. We only record a revenue when we get cash in. Very different from accrual basis accounting. Okay, so on the flip side of that, when cash is not received or paid, we don't record anything. Okay, so let's just look at a quick example really right here. So let's say a customer buys something from you for $10,000. They pay $3,000 in cash and then the rest of it on account. The remaining $7,000 is on account. Under accrual basis accounting, that whole $10,000, right? That whole $10,000 is going to be a sale, because that's the amount that was earned. And how did we earn it? Well, we sold something, which means we've earned that revenue. On the other end of that, we've got cash accounting, and the cash received would be $3,000, and so we'd only have $3,000 worth of revenue, because that's the amount of cash that we received. Okay, so that's the big difference. And then under GAAP accounting, or under GAAP, those generally accepted accounting principles, accrual, right, is required. You don't have an option. If you are filing with the SEC, that's where those 10Ks that we look at on our homework comes from, then you are required to use accrual basis accounting. You cannot turn your financials in using cash basis accounting. Okay. So I'll tell you right now, all of this up here, I would expect you to know that on your own without me prompting you for an exam. Okay. You should know that by now. What you may not know is this stuff here below adjustments at the end of the period. Okay, because this is the chapter 4 stuff. Now, I did ask you guys to please start watching the chapter 4 lecture videos beforehand. That way you've at least got some idea of what we're talking about, because it makes it much more difficult to follow along and try to keep up with this stuff if you don't know what we're talking about, right? And you've probably noticed that chapter 4 has built on chapter 3, and it has complicated things in such a way that if you didn't understand chapter 3, you're going to be really, really lost in chapter 4. So please, please, please watch those lecture videos, and I'd watch them more than once, honestly. Okay. So what we're talking about in chapter 4 is this right here, these adjustments at the end of the period. That's really important for us. And the reason we make these adjustments is because we need to show that our account balances are correct before we put them on our financial statements and send those financial statements out to those third parties that are interested in our financial information. We have to make sure that there are no material misstatements, whether we did it on purpose or by accident. Okay. We don't want people making decisions on bad information. Okay. Because that can get the investor in trouble, the creditor in trouble. It can get the business in trouble. It just leads to really, really bad things. Okay. So just keep that in mind as we go through chapter 4 here. So accrual accounting, what it really does is it creates these timing differences. Okay. There are timing differences that get created. And those differences are because we sometimes have sold something, like up here, right? We had $7,000 on account. So that means we don't have the cash yet, but we've already made the sale to the customer. So there's a difference in the timing between when the cash happens and when the transaction happens. Same thing goes for expenses, right? Think about like prepaid rent. Okay. We paid the cash up front, but we haven't had an expense yet. There is no rent expense until we've used some of that rent up. And so the cash flow is different than when the transaction actually occurred. So that is why we have these timing differences. We call them assets and liabilities, right? These are items that we are already aware of, right? That we already know about. Okay. We already know about assets and liabilities. We've been talking about them really since the second day of class. Okay. We make adjustments. Okay. So adjustments are made to update the balances of the assets and liabilities. That's what I was just talking about, making sure that our account balances are correct. Okay. These adjustments are necessary to account for transactions that occurred during the period. Okay. Like, we don't stop doing transactions after the first of the month. We are continuously engaged in transactions with third parties for the entirety of the month or for the entirety of the accounting period. So we have to account for those, and we account for those transactions through the adjustments. Okay. So we have to make adjusting entries before creating the financial statements. Okay. So what we're going to do now is we're going to take a look at several transactions and how we adjust them. And think about how these are different from what we did in chapter 3. Okay. And what we did in chapter 3 was we made the original transaction. We prepaid for rent. We bought this piece of equipment, so on and so forth. Okay. What we're going to do now is make actual adjustments to those so that at the end of the month, the account balance is correct. Because, hey, guess what? We've used up some of that rent, right? So now that we've used up some of that rent, we know that there is a rent expense and a decrease to that rent asset, or to that prepaid rent asset. Okay. What we see here to start with is our unadjusted trial balance. That unadjusted part is very important, because what this tells us is debits equal credits. That's it. That's all that tells us. Debits equal credits right there. Okay. And we can see that if we look down at the bottom. What it doesn't tell us is whether or not we have an error in our accounts. Doesn't tell us if our account balances are correct. Doesn't tell us if we've made an error somewhere. All it tells us is debits equal credits. That's it. And we're happy with that because we haven't made any adjustments yet. That's why it's called the unadjusted trial balance, right? Like, makes sense now. This is an unadjusted trial balance. Okay. So what we're going to do is we're going to look at some adjustments. Okay. So if you think about this one, this is adjusting journal entry 1. That's what that AJE means right there. That's just adjusting journal entry number 1. Okay. What we're going to do here is we're going to say, okay, remember back in the day, we paid 12 months of rent and it was $192,000. We paid it all at once. Okay. Well, what we got to do now is figure out how much of that do we recognize each month. So that 192 divided by 12 is going to be 16,000. So each month, we need to recognize $16,000 worth of rent expense. And the reason why that is because here we created this prepaid rent T account, right? And we put 192,000 in it. Well, now what we're doing is we're going to say rent expense every month. And we've got 16 coming out, which means we need to have 16 coming out of here, which means that after that happens, now we've got 176,000. Okay, this is really what's happened. These are remember, these are called your T accounts. Okay, they are very useful for you. All right, but that's essentially what's happening every single month. Okay, so we're going to go ahead and do that here. Right, so we're going to say, hey, we had rent expense. Okay, that's going to increase by $16,000. And then we've got prepaid rent, an asset that is going to credit to decrease for $16,000. Okay, and that is what we are doing. That is, in essence, not even in essence, just literally, quite literally, that is an adjusting entry. Now, this is a simple adjusting entry. It's the first one we're looking at, right? So just in case we need a quick reminder, we've got dead, if we remember. Now, this is the one I like to use. If you like to use a different one, please use a different one. But this just means that debits, increase, expenses, assets, and dividends. Okay. So the way I kind of figured out what accounts am I, what accounts am I debiting, what accounts am I crediting, is I went, okay, well, I know I have rent expense because I have used, or 1 month of that has expired, so I've used it. So now I know I have rent expense. And what is the other side of that? Well, it's prepaid rent. And so I just go and I ask myself, well, is rent expense an expense? It is. And so I'm going to debit that to increase it, which means I need a credit. That credit is the prepaid rent. You could also go, is prepaid rent an expense? No. Is it an asset? Yes. We're trying to decrease it, so we're going to credit it to decrease it, right? So that's kind of why I did what I did right there. All right, so moving on to adjusting entry number 2. So let's say at the end of December, supplies were counted and they totaled $80,000. The rest was used during the year. Again, you notice a couple of things here. It's time to start reading these transactions carefully. Used. When we see used, we know that means we have an expense. That expense in this case is going to be supplies expense. So we know our debit is going to be supplies expense. Okay. We just don't know for how much yet, right? We're going to figure that out. The other end of this is supplies. That's our asset that we're decreasing, right? And again, we just don't know how much that is yet. What we're going to do is we're going to figure that out. Okay. The way we're going to figure that out is we are going to, well, first I'm going to figure out how to erase all this really quickly so that we can have a clean set of T accounts and just walk through this together really, really quickly. Okay. So what we end up having is we've got the supplies account, right? And it started with, let's see, what did it tell us? It started with, if we look up here, we can see that supplies started with $20,000 in it. So what that is telling us really is that, hey, at the beginning of the year, we had $20,000 in here, okay? What we've done is, at some point during the year, we've used some amount of that, and it left us with $8,000 worth of supplies, okay? The way I know that $8,000 is what I'm ending with is, again, I'm just reading the clues inside of the problem. And so here it says supplies were counted and totaled 8,000. One other thing you can see is if it says on hand or if it says remaining. Okay. Well, that is a hideous bracket, right? Not going to try again. But both of these just simply mean ending balance. Okay. That's what that means. So if you see on hand, counted and totaled, remaining, right? That just means that is your ending balance. And so that's how I came to the conclusion that my ending balance was 8,000. So if we remember from last week or when we first started talking about chapter 3, we said the way to calculate an ending balance in an account is to take all of the increases less all of the decreases in that account, and that's going to equal 8. and that's going to equal your ending balance. Well, so now we know that X is what we spent or what we used for supplies, and that will become our supplies expense balance, okay? But we've still got to solve for X. So we're going to take 20,000 minus X equals 8,000. If we work that out, hopefully you can work that out, you'll see that X equals 12,000, right? So here, instead of X now I know I've got 12,000, okay? So this 12,000 is going to go right here to supplies expense as well, okay? This is your debit, this is your credit, okay? It's an asset account. So we go through our acronym and figure out that the debit is the increase, the credit is the decrease. So we have a $12,000 increase in supplies expense, a $12,000 decrease in supplies. And again, we're just going to write that in here. Okay. So that is your supplies transaction. I would be prepared for these on the exam. Okay. You will definitely need to be able to calculate what your supplies expense is for the month based on a question very, very similar to this transaction. Okay, so that is definitely going to be on your exam, I'll tell you now. Moving on to adjusting transaction number 3, this is where we're also going to have to explain depreciation very quickly. Again, please make sure that you're watching the lecture videos because that is going to make some of this a little more simple. I'm trying not to make this a 3-hour long video for you guys. So those of you that were in class can kind of skip to the next transactions. But those of you that weren't are definitely going to want to pay attention to this because now we've got to deal with this thing that we call depreciation. All right. So what depreciation is it is essentially us showing that we are respecting the historical cost principle by not changing the value of an asset or a long-term asset on our books from what the value was when we bought it. Okay, that's the historical cost principle. It's also a way for us to show that we are adhering to the matching principle. And again, if you don't know what the matching principle is, you're really going to need to study up. But the matching principle essentially says we match our expenses to the revenues that they've generated. Okay, so we are doing that in this way. Everybody conceptually understands what depreciation is. When I drive a car off a lot, it's less worth than it was when I got it. And that is true, but it is a very fundamental, basic understanding of depreciation. When we talk about depreciation in accounting, what we're really, truly talking about is that we are matching those expenses over a period of time. We only depreciate a long-term asset because we need to recognize the expense as we use that asset. And if we're using that asset for 5 years, for example, we need to recognize that expense over 5 years as we use it. Okay. So again, go to the lecture videos and watch that, but I'm going to walk through this with you really quickly. So what we've got here is it tells us that we purchased equipment on October 1st for $250,000. The equipment is expected to be used for 5 years. What we see here are a couple of fairly important pieces of information. Okay, the first one is what I would tell you is the date of purchase. So that's going to be October 1st. Okay, that's our date of purchase. This is important because we are performing this adjustment on January 1st, which means we didn't own this particular long-term asset for the entire year. We only owned it for 3 months out of the 12. Okay, so what we're going to have to do is we're going to have to take that initial cost, $250,000. Okay, we're going to divide that by its useful life, or 5 years. What we get is $50,000 per year that we recognize as depreciation expense. Okay. The way we figure out how much we owe in a partial year is we take this amount, okay, we multiply it times n over 12, where N is equal to the number of months the long-term asset is owned, okay? So in our case, what we would have is 50,000 times October, November, December, so 3 months over 12. This essentially, right, turns into 50,000 over 1 times 3 over 12. Hopefully you guys can do a little bit of math and you'll see that it's really, at the end of the day, 50,000 times 3 over 12, okay? Which means that we've got 150,000 divided by 12, which means we've got, I believe, $12,500 per for 3 months of depreciation. So $12,500 is what we have for our depreciation for 3 months. Okay. This is partial year depreciation. You will also be calculating this on your exam. Okay. The other account we have to talk about now is this thing we call accumulated depreciation. Okay. So what you end up having is you've got equipment. Okay. That's your asset account. Okay. When we bought it, it was worth $250,000. Okay. We can never change that because of the historical cost principle. That always has to be $250,000. We do know that every month, right, or every period, whatever the case is, we're going to have a depreciation expense. Okay. And that's right here. And we figured that that's $50,000 per year. Okay. So we know that we had it for 3 months. So we've got 12.5, right, for those 3 months. Now the question is, I've got my debit right here. Okay. But where does my credit go? Can my credit go here on equipment? Well, if I put it here on equipment, right, what happens to this? Well, it all of a sudden becomes 237.5, right? We can't have that because now our balance has changed. So what we actually end up having is this thing that we call contra asset account. And contra simply means other, opposite, against, right? It's just the opposite of an asset account. So what we get is we have this thing called accumulated depreciation. It is an asset account, but it holds its balance on the opposite side. So it increases with the credit because it is a contra asset account. So that 12 and a half actually gets matched over here to accumulated depreciation. Okay. Now, accumulated depreciation is a permanent account because it is an asset account. And so it will never close. It just keeps on counting the amount of depreciation that we have since we bought the asset. Essentially, it accumulates depreciation over the life of the asset until it's been fully depreciated. Okay. And what I mean by fully depreciated is that what we'll have is on our balance sheet, you'll see equipment, right? And that's given at the $250,000 historical cost. Under that, we'll now see it says less accumulated depreciation. In this case, a single year or 3 months. And what we get is what we call net book value. Okay, that net book value becomes $237 or $237,500. Okay, this net book value, that's why we do this, right? And we'll talk about this later on, much later in the course. Okay. All right, so we're going to go ahead and finish that transaction up. We're going to journalize it, and we're going to say depreciation expense, 12,500. Okay, and we're going to say accumulated depreciation, same amount. Okay, that is probably the most confusing transaction that we have looked at to date, with the exception of maybe the transaction number 7 that was revenue and expenses at the same time. Okay. All right, they get a little bit easier from here on out. So looking at deferred revenues, again, remember deferred revenues are a liability for us, right? So let's say that on August 1st of 2024, the company collected $12,000 in advance from a customer to provide consulting services for 1 year. The entire amount was initially recorded in deferred revenue. Okay. So what we're going to see is we are going to go ahead and increase our cash. Okay. We increase that cash by this amount, 12,000. Okay. What we're going to increase as well is that deferred revenue account. Okay. This is our credit. Remember, this is a liability. Okay. It's a liability because we have not done anything to earn it yet. We are contracted for consulting. Okay. It tells us right there we are contracted for consulting. So we haven't done anything yet. As of August 1st, we haven't done anything. All we've done is just record the transaction. Okay. Now let's move on to accrued expenses. This is when we're going to pay the amount later. We're actually going to pay the cash later, but the expense actually happened in the current period. What we're going to look at here are salaries payable, essentially. Okay. So let's say on December 31st, $3,000 in salaries have been earned by the employees, right? So they've earned them, so we've got to pay them. Okay. But it was for the final 3 days of December. The salary wages are not actually paid to the employees until January, which is the next month, even though a portion of their wages were earned in December. Okay. The wording on this is a little confusing. All this is really saying is, hey, we used their labor during the month of December, so we have to have an expense in December because they helped us generate revenue. The use of their labor in December helped us generate revenue. However, we don't actually pay them cash, right, until January. So we have to recognize that fact. And the way we're going to recognize that is by creating a payable. Okay. So what we do is we say, well, we've got that expense because we used their labor. We're going to call that salaries expense. It's $3,000. Then we've got salary payable for $3,000 to remind us that in January, when we let go of that cash, right, when we actually pay them, we have to reduce that payable. We no longer owe them that money. Okay. All right, so moving on to adjusting journal entry number 6. On October 1st, 2024, company borrowed $250,000 from the bank. The related note required principal and interest 10% to be paid on September 30th, 2025. Okay. There's a lot going on in here that you won't think about until you stop and read it. October 1st, very important date, right? That tells us how long during the year we had the loan, which is going to help us calculate how much interest we owe. Okay. This is your principal, $250,000 for your amount. We'll call this the amount in a formula I'm going to show you here in a second. Okay. Then we have 10%, which is our interest rate, which is also incredibly important. With that, all those 3 key pieces of information, we can calculate what our interest payable should be. Okay. So the first thing I'm going to do here is I'm going to show you guys that original entry on our T accounts, what the original entry looked like. So if you recall, we're going to say, okay, we got cash, some amount of cash. Okay. That amount of cash was $250,000. So we got cash in the amount of $250,000. Okay. But we also created a note payable, right, for the same amount. Okay. That was the beginning of the month. Our journal entry, or the beginning on October 1st. So our journal entry looked like this. Cash debited for $250,000. Notes payable credited for the same amount. Okay, this is chapter 3. What we're going to look at now is chapter 4, because now we're in January and we need to record the interest that we owed on that, the interest payable for that. Okay, that's what this particular problem is asking for. Okay, so we're going to remember that our amount was equal to 250,000. Our rate was equal to 10%. Okay, and the amount of time that we had it was October, November, December, so it was 3 out of 12. Okay, what I'm going to show you is something called the ART formula. This will help you create or help you calculate how much you owe on interest. Okay, so as of January 1st, what we actually owe in interest is the amount times the rate times the time. We call this our ART formula. Some people may call it your PRT formula, your principal times your rate times your time. I like ART better, so that's what I use. It's your amount times your rate times your time. It just rolls off the tongue easier. Okay, so in this case, we're going to take 250,000. We're going to multiply it times 3 over 12, and then we're going to multiply. Oh, excuse me, I got ahead of myself there. We're going to multiply that times 10%, and then we are going to multiply that further by 3 over 12. Okay. Let me pull my calculator up here so that I don't do silly things like head math. Okay. All right. So what we get, 250,000 times 10% is what? 25,000. Okay. And if we multiply that times 3 divided by 12, okay, what we get is 75,000 divided by 12, which gives us $6,250 worth of interest. Okay, this is what we're going to call interest payable because we have not paid it yet. However, remember that we have used that money to help us generate revenue, which means we have an expense. So we have interest expense and interest payable that we have to account for here, and that's what we will do in this journal entry. Okay, so I'm going to go interest expense. Remember, it's an expense, so we debit to increase, $6,250. I'm going to go interest payable, $6,250. Because essentially what's happening here, what's happening here is that at the end of this note's life, once this note matures, we will actually owe them $275,000. That's what we'll pay them, right? That is the principal plus all the interest, okay? We're not actually paying that interest or the principal back until the end of the note, until the note matures. So in the meantime, we continue to create this interest payable account to keep track of that $25,000, okay? All right. One thing I do want to go do, I think I may have messed this up. I need to show you the other end of adjusting journal entry number 4 right here, because what I showed you was the original chapter 3 entry. Now what we got to talk about is that chapter 4 entry, right? And that chapter 4 entry is just essentially how much of that revenue have I gotten to recognize. So as we provide services throughout the year, we're going to be able to recognize revenue. So we know that we've got service revenue here, okay? And we're going to reduce our deferred revenue there, okay? Now, I don't want to confuse you guys. That to you, that may look like 2 debits. It's not, okay? We got service revenue here as the credit. What we got to figure out is how much. So they tell us here we got $12,000 is what we were paid by them in advance on August 1st, right? We got August 1st right there. Okay. It's for 1 year's worth of service. When you look at contracts, okay, when you are doing a contract, you recognize the revenue evenly throughout the year, meaning every month you're going to recognize 1/12 of the revenue. So in this case, we've got a really easy calculation. We got 12,000 divided by 12, right, equals 1,000 per month. Okay. And then all we're going to do is count on our fingers: August, September, October, November, December. I'm going to take 1,000 times 5, and that gives me 5,000. Okay. So I'm going to recognize $5,000 worth of revenue here. Okay. All right. So those are the first 6 journal entries. We have one more to go, and then I'll cut this video at this point, and then I'll make a second video that is just the remainder, the adjusting trial balance, the income statement, equity, balance sheet, and then we'll talk about closing entries and then complete a post-close trial balance as well. So I'm going to go ahead and finish up transaction number 7 here for you guys, adjusting entry 7. This is an accrued revenue. So this tells us we're going to receive cash later on for something that we already provided right now. Okay, so this is an instance of, if you think back to like transaction 7 from chapter 3, where we sold the robots on account. And so we increased revenue and we increased accounts receivable, but there was no cash yet. Cash is happening in the future. That's what we're doing here. Okay. So on December 31st, services $10,000 have been provided to customers, but have not yet been billed or collected. Okay. So what we have to do here is we are going to create an accounts receivable. Okay. And we are going to create that revenue. Okay. Very simple. Very, very simple. So all we're going to do here is we're going to say, well, we're going to increase account receivable. Right. This is AR by 10,000. Okay. And then we are going to increase our sales revenue or service. Well, this was service revenue, not sales. Okay. Same difference, kind of, just for $10,000. Okay. Very simple, very easy. The next video, we'll go ahead and we'll complete our, adjusted trial balance. I'll explain why we do an adjusted trial balance, what the big important part is. We'll go through and we'll find the totals in our income statement, total in our statement of stockholders' equity, the balance sheet, all that good stuff. And then we will finally close all of our accounts that need closed, and we will transfer that information to the post-closing trial balance.